Hey gang, welcome to Time in the Market, the channel where I talk about random investing crap. Today we're talking about another Spac investment presentation, so get ready for about an hour of random babbling about something that I just found out about this morning, and that is Vivid Seats going public via Spac, via one of the Horizon Acquisition Corporation's HZAC. It was announced yesterday. Stock was up a little bit, so people are vaguely excited about it. Not a huge bump. I think more people are waiting for HZON, actually, the SPAC, the other SPAC they have that is probably, supposedly, going to announce Sports Radar at a wild valuation. I'll probably do a video on that. I do own HZON. I do not own HZAC, but I'll take a look at what the company's about while I do this review. So remember, I'm not a qualified financial advisor. Please do your own due diligence. I'm just doing this for fun. Please talk to a qualified financial advisor before you make any investment decisions, etc. I am not a qualified financial advisor. Do have a finance degree, but I am just doing this for funds and entertainment. I did some prior dig in to kind of find the few companies that are vaguely comparable. It's kind of hard to find a comparison because some of these competitors are either part of a larger business like Live Nation or not really publicly traded or just recently sold. So Stubhub, for example, is part of eBay and they were recently sold, and that sale is still kind of taking place right now, so it hasn't really been finalized, even though it happened in 2019. But let's dive into Vivid Seats. Let's see what this business is about. And I don't think this video is going to be as long as my other videos. This is a secondary ticketing marketplace, so essentially legal scalpers, right? People buy tickets from event venues, whatever, put them on sale on some of these apps like Vivid Seats, StubHub, SeatGeek, etc. Sellers, buyers are also part of this ecosystem. They buy Vivid Seats, takes a part of that revenue and keeps it to run the business and also make a profit, right? So the take rates here are actually pretty high. When I was doing some reviews on some of the other competitors, you can kind of go into the 10K of eBay for 2019. I'm going to base a lot of this comparisons based off of 2019 because we all know what happened in 2020 and is happening in 2021. These are basically no revenue companies in 2020 and 2021 because of the pandemic. If you are not aware of that, there's been a pandemic going on that has really ravaged this industry, the live events industry, and has really hit these businesses hard. But what's interesting, if you look at companies like Live Nation, which is the publicly traded comparison, is that it didn't really take, it took a huge hit, obviously, but the recovery play is in full motion now. So these valuations are kind of back to pre-pandemic levels on the expectation that, there's pent-up demand for concerts for one thing, but also that we're going to get at least to where we were prior to the pandemic with live events. And that's certainly the thesis here, that, hey, this is a reopening play in a big way. And Vivid Seats immediately becomes one of the only ways to trade a secondary ticketing marketplace on the public market. If you're interested in investing in that, well, here it is, right? You can obviously invest in Live Nation, but that comes with other businesses, live venues, etc. So it's not all comparable. It's not all Ticketmaster that you're getting, but you're getting Ticketmaster plus more. You could have invested in eBay before they sold StubHub to Viagogo, and I think Viagogo is a private company in Europe. Then you've got companies like SeatGeek, etc., but I believe those are still private. So the only pure secondary ticket marketplace play, and that's an interesting business model, and certainly one where you can generate pretty good cash, because once you have the app set up, right, this is a sort of self-sustaining business model. As long as you have buyers, as long as you have sellers on the platform, you obviously have to run the platform and make sure that it continues to run well, but you can probably make pretty good money. And I would think that this is a free cash flow positive business at this point, since they already have a mature business in play and a really solid structure and app. I don't personally use secondary ticketing marketplaces. I generally try to buy from the primary market, and if I can't get it there, I just can't get it there. I don't feel like paying a premium. But I am not the target customer here for these apps. I'm not a person who goes to a lot of events. The last sporting event that I went to was like a Nets Raptors playoff game, maybe like 8 years ago or something like that. I don't remember when that was. It was at the Barclays Center. It was cool. The last musical event I went to was A Perfect Circle, maybe years and years ago. Giving you a taste of my music. And then I see musicals from time to time, but again, most of those I just buy from the primary market when I can. And when I can't, I just don't go. Not a big deal. Not a huge fan of events, but there are a lot of people who are a huge fan of private events. And that is the market that they're targeting. And now that places are starting to reopen, you sort of saw that with MLB games being packed before the vaccines were even rolled out. So there's certainly a pent-up demand for live events, and they are one of the bigger beneficiaries from when that happens, because they're going to take a big chunk of that pie if and when it happens. So capital structure, they're rolling over 100% of their equity, so that's good. $752 million of proceeds are being used for debt repayment. So, they're not keeping it in cash, but they're repaying debt to lower their net ratios. They have $544 million in cash, including $155 million committed by Horizon themselves, and a pipe of $225 million. So a decent amount of cash. Nobody's selling. They're using that money for capital structure improvement, which is good. It'd be better if they didn't have a ton of debt and they could have kept some of this in cash to invest in the business. But hey, that's fine. I'm sure they're retiring debt that's at a higher interest rate than they could potentially get now on the market with how low interest rates are. So they'll still have capital efficiencies there. They'll be able to borrow if they want to grow, acquire, whatever. But now they have a better balance sheet because of this merger. So seems like good capital structure. Nobody's selling, more money into the balance sheet. Valuation, $2.1 billion enterprise value. Implied EV over Ebitda of 2019, which is what I'm going to look at, of 16x, and then attractive valuation versus other digital marketplaces and ticketing peers. So we'll see what that means, but I will pop open my trusty Microsoft spreadsheet, trying to give Google some free advertising here, but it's Microsoft that I should be doing that too. And now we've got HZAC, or let's just call it Vivid. We've got an EV of 2100, and we've got 16x EBITDA, so divided by 7.1, an EBITDA of about 130 for 2019. These are EBITDA values for Live Nation. Some values for Stubhub. Unfortunately, since Stubhub is part of eBay right now, you can kind of go into their 10K and peruse it and find some of this information, like actual net income, actual revenue for Stubhub from 2019 before they were sold off for $4.05 billion to Viagogo. But some of the other stuff like Ebitda is kind of harder to get at based on how they show their data, so I don't have that, but I'll have some sort of comparison to compare it against. And another thing to keep in mind with Stubhub valuation, it's a 2019 valuation, and if you look at LYV, which is probably the best proxy, depending on when the valuation happened, the stock is up a good 20% since then, right? So as crazy as it sounds, these companies that made no revenue in 2020 or 2021 are more valuable than they were in 2019, simply because, again, the stock market is forward-looking. It makes sense. It might not make sense to look at it from a historical perspective. Obviously, your valuations based on 2020 or even 2021 revenue are going to be way out of whack, which is why I'm looking at 2019 revenues. So good info here. I like how this is presented. They show you all this information. Mr. Todd over here, CEO, CFO, and director of Horizon, he's got a good track record. I'm in some of his SPACs. He's had some investments here that he outlines, like the Dodgers and the LA Sparks and DraftKings. I do own DraftKings and A24. They make good movies. Experienced management team. You got a CEO who was the CEO of Grubhub before. A lot of other people here that I don't know. Our mission, to resell tickets to people, make it easy to scalp tickets, basically. You can kind of see over here, I talked about the take rates. So these guys have $2.3 billion in gross order value, how many tickets are sold, and they keep $469 million of that in terms of their own revenue. So their take rate here is about 20%, right? That's pretty hefty. So it's a 20% boost to actual ticket prices, at least. That's not even accounting for the amount of money that the sellers want to make on top of what they paid for the tickets. So clearly, this is, I don't want to say it's not the best business model for buyers, but at the end of the day, Is it, these guys are taking 20%. Whoever is buying the ticket from the primary marketplace and selling it on this platform is taking X. So the person who's actually buying from Vivid Seats is probably getting, at least a 30 to 40% bump to whatever they would have paid if they bought it in the primary market. But this is how it works. There's a couple of these resellers, and you can kind of see that the revenue transfers over to pretty good Ebitda. So decent margins on this business, right? You wouldn't expect it to be otherwise. They're not really doing a lot of the work. Somebody is, there's active sellers on the platform. There's active buyers on the platform. The platform just has to be around and be usable and be user friendly and probably drive users to the marketplace via marketing spend and or allowing them to experience something better than some of the other platforms. Whether you're buying from Ticketmaster, which is kind of a primary marketplace, or SeatGeek or StubHub, right? You're paying a bunch of additional fees on top of what you would pay normally if you're not buying through the internet. And these days, you sort of have to buy it through the internet because of how the market functions. So it sort of is what it is, but hey, yeah, scaled, growing, highly profitable. I totally agree with that. This is going to be a profitable business. You've got a two-sided marketplace. There's sellers, there's buyers. They benefit from both ends. They don't really have to buy tickets themselves. It's a large market, right? People like live events. They like going to venues, etc. They are trying to acquire new customers. They say they have an efficient customer acquisition model. Whether or not it's better than any of the other apps, it's a question. It's questionable. And then you've got strong profitability and cash flow with a lean cost structure. So pretty good EBITDA margin, pretty solid EBITDA to free cash flow conversion, right? At least in 2019. Obviously, 2020 is going to look like garbage because of 2020. They've got their ecosystem, distribution partners that they work with, Vivid Seats infrastructure with a marketplace, whether it's via app, desktop, or website. And then you've got a Skybox free-to-use ERP system with direct integration across all marketplaces. Don't really know what Skybox is. Hopefully they explain that. Got a broad portfolio of events. I don't know enough about this market to have a good say as to whether or not these events are unique to this. Do they have the rights? Do these companies buy the rights to work with X, Y, and Z? Can you only get Cubs tickets through one platform? Because if you're a Cubs fan, obviously you have to go through Vivid Seats. If it's available on all platforms, and I would hope that it's available on all platforms, that these teams, events, etc., aren't making exclusive deals for the sake of the customers, then they have to compete on product quality, price, etc. So I think it's a competitive marketplace. You've got 3 to 4 big players, and that's probably not going to change because it is a profitable business model. Unless there's more entrants into the market, pushes prices down, makes it even more competitive, which obviously would be good for customers, but not good for investors. So concerts shut down, still probably shut down, maybe starting to go back up. Sports starting to go back up, many without live audiences at this point, but maybe that'll change soon. And then theater, as far as I know, is still closed down. But starting to open back up again into the latter part of the year. So I think this is the recovery year, assuming that goes as planned. There's a Seinfeld musical or play. That's weird. Assuming that goes as planned, by the end of this year, hopefully these guys are kind of back up and running to at least annualized revenue that they saw in 2019. There might be a bit of a lag on some of these events, right? Maybe people aren't going to be as comfortable going to a fully sold out concert, especially if it's standing room only, where you're just, ass to ankles with other people. But that'll change going into 2022. Sports events, like I said, some of these have already sold out. So certainly in certain states, there's comfort with just being around people as more and more people get vaccinated. Hopefully there's no, secondary outbreaks due to variants, etc. This is a business that's really going to benefit from the post-pandemic boom in a big way. And they're certainly set up in a good way to do that now that they have capital efficiencies, access to markets at lower interest rates, probably better balance sheet, a better balance sheet and stuff like that because of this merger. So benefits to sellers, good management, fair pricing and terms, etc. Benefits to buyers, efficiency, value, inventory of events, brand trust, confidence, customer service, reach, awareness. But you could probably say the same thing about StubHub. You could probably say the same thing about SeatGeek. You could probably say the same thing about Ticketmaster, whatever apps you have out there, right? They're all going to be sort of similar. I don't know what guides people to one over the other. If you are a user of Vivid Seats or StubHub or whatever, let me know down in the comments if you like one over the other, right? That's something I will probably have to do more research on before I commit to investing in something like this. You want to know what's Vivid Seats actually doing? Because a lot of these things are so generic, right? We have a broad inventory of events. Doesn't everybody else? We have brand trust. Doesn't everybody else? We have reach and awareness. Doesn't everybody else? We have customer service. Doesn't everybody else? Is your customer service better? Is your inventory of events better? Do you have exclusive deals for some reason? Hopefully not. Is your brand trust better? Is there data that shows online that people like Vivid Seats better? Even if it's just looking at app scores on app stores, even if it's just going to websites online that says, oh, X, Y, and Z is reviewed at 3.7, the other one's at 3.2. Is the efficiency value good? Are they actually making sure that they're not selling bootleg tickets? Are they doing events that make their buyers or sellers feel like they are more than just a money churn for them, right? I read something the other day where one of the other companies, I won't name which one, basically, hey, if you bought a ticket to the Super Bowl through this company, they basically rolled out the red carpet for you. They had limos waiting for you at your hotel. They drove you to the Super Bowl. They were waiting for you when you got out there, and it was an added value that they provided. And it's obviously not for every event, but that sort of thing goes to show that some of these companies do more for their customers than just being a secondary marketplace. So interesting to note that they kind of have this generic marketplace value proposition here. You would want something more direct that kind of shows that, hey, Vivid Seats is better than Stubhub because of X, Y, and Z. And I don't think that this shows that. Supply demand dynamics. So you've got a large and growing market. Secondary is growing just as fast as the primary is growing. There's a lot of reliance on touring income. Sports teams obviously make their money from live events, etc. There is pent-up demand. There's higher disposable income potentially if people didn't spend a lot of their money on things like house improvements during the pandemic when they couldn't really go anywhere. This is true. I totally believe that there's probably right now there's not enough supply to meet the demand. Once the supply is up there, the demand's still probably going to be there to meet that supply. I think there's upside potential in the recovery period that it will eventually kind of even out, but there might be a boost in growth even over, like realized if 2020, 2021 never happened, 2022 would have been at X, right? Now that 2022 revenue might be even higher than X by X percent simply because there's pent-up demand and it's going to get you to a higher curve as if it didn't happen before. So they're kind of saying, hey, cumulative personal savings have gone up through the pandemic as people stayed inside, and then people are itching to get back on tour. There were X tours for artists selling over 500K in tickets, Live Nation tickets. Hey, competitor. And then that number dropped to 0 in 2020. You've got that number sort of starting to get back to slightly below the norm in 2021, and then 2022 is going to have a boom. So a lot more touring is going to happen as people who probably planned tours in 2020, 2021 now all stack it into 2022. So 2022 should be a big year. 2023 will probably kind of be a return to more of a norm, right? If this was 26, 25, 0 to 15, 45, maybe this will be in the 20s again, right? That's sort of what you would expect, but who knows? Track record, what are they doing? So business launched in 2001, didn't really start taking off until the platform started to mature in the early 2000s, right? It's all about what is the switch to internet in terms of a lot of these internet-based companies, right? A lot of people still weren't comfortable using the internet for everything in 2009. Now, these days, everybody uses the internet for everything. So I would certainly buy tickets online, whether it's through a primary or secondary platform. If I really wanted to go to something, I probably wouldn't go to the box office myself unless I lived right next to it to buy tickets. When I bought my Hamilton tickets a couple of years ago in the local tour, I bought them through the primary market directly through the company the venue that was holding the production. So that's just me. There's obviously other people that are using the secondary markets because sometimes you just can't get that stuff on the primary market. I'm not the type of person who says, oh shit, I have to get anything. But there are people like that who will pay whatever it takes to get some of these tickets on the secondary market, and these guys can make a lot of money. And then you can kind of see, crap, what happened here? And then we're rebounding and expecting to go above where we were before. But you can kind of see that this thing was already sort of evening out before the pandemic. So that's an interesting trend, right? There's obviously a lot of growth here. And then there's like, well, are we peaking? Growth rate here is kind of low for a company that's still claiming to be a growth company and comparing itself against digital marketplaces. So this is a bit concerning before we even get to some of the financial decisions. What did they do during COVID, during the pandemic? Reduction in cost structure was big, quick, etc. Overall cost reduction of 80%. So they were probably still burning a ton of cash, right? They have to provide refunds, cash refunds for canceled things, etc. So that's interesting. They've got a unique value proposition. Well, they've got a combination of growth and profitability, whereas SeatGeek, for example, I don't know the financials, but this is the claim. They're growing quickly, but they're not profitable. StubHub isn't growing that quickly, but is somewhat profitable. We're growing quicker, and we are profitable as well, just like Ticketmaster. So is that true? We'll see. I have the data here for StubHub. Let us copy it. So this is StubHub data, revenue from, they just combined it. 1121, 1,083, 1,029. Well, those numbers, they were indeed. So growth rates here for StubHub, 3 to 5% year over year. Not great. The claim here is that they're growing faster than that. So we'll see if that's true. And again, they have a freshly capitalized balance sheet to accelerate momentum. Like I said, they can borrow money at lower rates now than they probably did whenever they borrowed money in the past. Grow via marketing, I don't know if there's any acquisitions they can make, but potentially something on the back end. They're probably not going to acquire SeatGeek. They're probably not going to acquire StubHub. The StubHub acquisition by Viagogo is kind of being held up by regulatory issues in Europe. Is it even going to happen? It was done in 2019. I think it's April of 2021, and it's still not happening. So who knows? Maybe eBay will actually retain that one for all we know. Benefits, they're positioned to benefit disproportionately from the market rebound. So why? So they have significant goodwill created during the pandemic amongst key constituents. They've got a lot of cash refunds, royalty, or charity upon event cancellation. There's a net payment model with sellers in March. I don't know what that means. There is a first marketplace. They were the first marketplace to normalize payment terms with POD plus 15 rollout in November. Still don't know what that means. Again, you can kind of see that I'm not super familiar with this area, but some of you might know more about the platforms and what these payment models actually mean. They have the best in class buyers and sellers platform. Sure, everybody will say that. They've got a leading system for the seller community. So yeah, maybe if sellers are happier with the ERP model than with other ones, then hey, maybe this is better for them. But that's not something I know. That's some more due diligence that I would have to do as an investor to kind of be comfortable with this investment. But at the end of the day, if I want to make an investment in the secondary reseller marketplace, this is really the play, right? This is the only play you've got. You can make Live Nation, but this is probably going to be more of a primary investment in that secondary marketplace versus other stuff you get with Live Nation. And they've got a favorable event mix of concerts and theater, which potentially gives you more margin. I will agree with that than sports tickets relative to competitors, because those are very unique events usually versus sports teams, which are there 82 times a year or something like that when it comes to ticket sales. Platforms, blah, blah, blah. They got raw data. They've got platforms and algorithms. They've got great marketplace benefits. I think this is, for me, a lot of these apps are kind of the same. So I'll have to do more research on this. If you know anything about the benefits of Vivid Seats versus other secondary marketplaces, let me know in the comments. I'm certainly willing to learn about all that stuff, and I want to learn about all that stuff, and I'll probably do the research on my own later if I want to make an investment in this, but not something that I'm familiar with right now. Again, platforms, I've seen these all before. They look cool. Nice, good stuff. Simplified purchases, transactional path. There's a rewards program, which is always nice. Keeps people engaged. There's engagement, discovery, etc. Personalized to you. So you're talking about that retention program. How many mobile app transactions are there versus apps on the web versus transactions on the website? I think you're going to see this grow. Obviously, this is the growth pattern. More and more people are just using their phone to access their internet via apps or even browsers. Less and less people are using the actual website to buy tickets. It's just so much easier to do it on your phone on the go wherever you are. So this makes sense. It doesn't necessarily mean that, hey, we have a better app or a better loyalty program. I think most of the people actually saw this sort of transition into purchasing via app because that's what it's meant for, right? That's what the app's designed to do, to make it easier for people to buy tickets online, and it's certainly the easiest via your phone, no matter what you do. I buy most of my Amazon stuff via the app. I don't go to the website anymore. That's just the same thing as it is here. Before, I used to primarily buy things through the website. Now it's primarily through the app. Best in class seller technology with their point of sale platform. If there are any sellers out there that use this platform, let me know. But again, I don't have any reason to disbelieve any of these things, but you are talking about a presentation that's designed to sell you on something and value something at the highest possible level. So they're going to say they're the best at everything. It doesn't mean that they are. It also doesn't mean that they're not. I would think that most of these apps are pretty user friendly at this point for both the buyers and the sellers. And if they're not, then they will get there pretty quickly because users will clearly tell them through their usage of the app versus the usage of other apps. So if you look at their revenue growth, right, these guys are high growers according to versus StubHub. So you're talking about 415. Whoops, wrong way, sucker. 415, 453. 471. So growth rate 3.5%, 3.9%, and then 9% the year before. So whoa, they're burning StubHub, leaving them in the past. I mean, they're growing at 0.04% faster between 2018 and 2019. Ha, what growth. So, this doesn't seem to me like it's a growth play, right? There's even their projections in the future here are 525. I mean, 525 over a kind of a depleted year, but let's go 591 divided by 525. I mean, can they really grow at 12% when historically they've grown at 4 to 9%, as their revenue matures? Maybe. There's certainly going to be an uptick due to the pandemic. If you just said 471 at 4%, so this would have been, if it was a normal year and they continued growing at 4%, this would have been 2020. This would have been 2021. This would have been 2022, 2023, 2024, right? So they're basically getting to kind of where they would have been if they continued growing at an organic pace without the pandemic. So this isn't crazy to me, right? It's sort of saying, hey, we're normalizing, we're getting back to growth patterns. Some of this pent-up demand is going to show up here. So you're talking about a business that's potentially growing really at a realized 4 to 5% range, right? Which isn't amazing. It's not terrible, but this isn't the growth business by any means. This is sort of a business that says, hey, we're already feeling that we're kind of mature-ish, but, maybe we'll grow a bit faster in the future because of this demand. I would hope that some of these growth rates would be higher for a business like this. This is an app-based business. But it kind of speaks to the fact that there's probably a lot of competition here, that it's not easy to move people from one platform to another. And once you move them, they probably stick around. And this is going to grow in line with potential market growth, right? And maybe acquisition of new customers into the secondary marketplace, right? So if the market's growing at X%, there's a couple of boosts for acquisition of customers. You're not getting a ton of growth here as an investor. You're sort of getting a company that's relatively mature, but that's not a bad thing, right? This is also a company that's producing cash flow already. Like I said, this is an easy margin model. You've got 128 million in 2019 Ebitda. Let's pop that in there. Actually, 120, 134, whatever, 128. Your free cash flow is, let's say, 145 mil. So pretty good free cash flow conversion compared to some other companies that you see. And that's probably mainly because they don't have a lot of assets to depreciate, right? When you talk about Live Nation, their net income to EBITDA to EBIT, they have a decent amount of debt, but they also have a lot of venues that they depreciate and amortize. There's amortization that goes into that impacts their net income. So not seeing a lot of that with these guys, so there's probably not a ton of D and A. Don't have the EBITDA for StubHub, but maybe we can make something up to kind of get a comparison. So we've got revenue of 471. We've got an EV of 2100, growth rate that's kind of in line with Stubhub. I don't know what the growth rate for Live Nation is. Let's check that out. Morningstar. Financials. I just look at 2019 over 2018. What did they grow at? 1155 divided by 79. So these guys are actually growing at a faster pace off a larger revenue base, which is interesting. So, you know, nothing overly impressive, but you are getting a business that's going to continue to generate free cash flow, and those are generally more valuable, which is a good thing. Key metrics underpinning the forecast: orders are going up, total gross order value is going up, marketing and loyalty spend is going up between 21 and onward. Same with marketing. They're trying to attract more customers, so you can kind of see the dip in free cash flow here as they spend a bit more money and get less revenue also, and then that cash flow kind of starts to recover. And this is really good cash flow conversion, really good cash flow generation from this revenue, and it comes down to their take rate off of the gross order volume, and also the fact that, you know, their business model is relatively easy to make money off of. You know, they're a middleman between a buyer and a seller, right? And once that app gets going, your main expense is kind of marketing and loyalty to attract new customers. And you would hope that some of this spend would translate to much higher growth rates, but it's not. So that's kind of disappointing as an investor. You're talking about, hey, potential upside to some of their Ebitda forecasts of, what are they, 110, probably going to whatever. What else can they do? If they gain market share, it's pretty solid, you know, 35 to 70 million. I don't know what their actual market share, they don't say, but it's, you know, it's probably not huge if they can easily gain 5 to 10%. Marketing efficiency, if they can become more efficient in their marketing spend, if there's industry growth that's beyond what they're expecting, if there's an increase in average order size that's beyond what they're expecting, you know, they don't say what this is, but it's, you know, it's clearly double. You know, if they can double their EBITDA, that's clearly going to translate to, you know, much better cash flow. You're talking about conversion that's almost in 100, that's 100% plus. So this would become a much better value if all of those things happen. But again, these are major ifs, but they're certainly saying, hey, if there's upside here, you're going to like this investment. And maybe they're saying with that, hey, maybe we're being conservative with these numbers. And I don't disagree. This seems like back to normal, right? We're not really gaining a lot of market share. We're sort of trudging that path of 4 to 5% growth to get to this 2024 number. If we can do a couple of these other things, if we can use some of this new money to execute better, gain some market share, etc. And if you believe this is the case, then these valuations that we're going to talk about are probably conservative. And I don't know enough about the business model or the app itself to make that case, but there's certainly upside potential here. So they're comparing here against other companies that are in this space or sort of in this space. You know, they're comparing themselves to like Etsy or something like that. Revenue growth assumptions, they're in line with Live Nation. The revenue growth plus EBITDA margin, sure, I guess that's a comparable. Blah, blah, blah. You know, I don't think a lot of these companies are that comparable, honestly. I guess they're all online and they have apps and stuff like that, but they're in completely different businesses. So sort of is what it is. That's kind of the tough thing you have to decide as an investor. What's a good comparable? Really, for me, you're looking for things that are in the same area, that are in the same margin place, that are in the same growth space, right? They're comparing against Etsy, but if you look at it against Etsy growth, in terms of revenue, this is not a 4% growth company, right? This is a company that has been growing by 50% year over year and basically doubled in 2020 due to the pandemic. I do own Etsy stock, FYI, but it's not a good comparable to me. So I don't know why they're putting some of this stuff in there, but I guess they have to put something in there to show that, hey, look at us. We're an internet-based company, and we're using, you know, they're certainly not just showing revenue growth. I mean, 22 to 23, is it really 14.4%? Where is that the case? I don't think I saw that. Was it 14.4? Did we do that calculation? 591 divided by 525. It's 12.5. So are they doing 3090 divided by 2728. Maybe, I don't know. I don't know where these numbers are coming from, honestly. 23. Oh, they're doing 23 over 22. I'm a dumbass, sorry. Yep, that makes sense. But is that, this is a year that's limited by whatever, and this is a year that's boosting you. So it's like, not a great comparison. I think realistically, you want to compare what are these guys growing at in their already mature years, because that maturity is going to kind of normalize, as I showed by doing that 4% calculation and getting back to 2024 revenue. You're basically just normalizing back to where you were, right? This isn't anything special that you're growing 14% between 2022 and 2023, right? It's just a normalization of the industry back to historical norms. I'll use norm a lot there. Your enterprise value, I mean, this isn't expensive in terms of some of these other companies. Etsy's, in terms of, if you just look at, Ebitda or something like that, or revenue, etc., this doesn't seem very expensive against some of these other companies, but these are high growth companies, right? Is this a high growth company? I don't know. Not real great comparisons here, but it could become a higher grower if some of these other things come into place for them. Is it right now? It doesn't seem like it. I mean, this seems like it's a mature competitive business where you have to execute really well to see growth. And if you believe Vivid Seats is positioned to do that, then this is potentially a good valuation. If you can bump this historical growth rate, between 4 to 9% into the teens, then you're looking at a decent value here. But compared to some of these other guys, if we look at some of their, let's say, EV over revenue 2019, Live Nation here is at about 1.8. Stubhub is at about 3.6. Vivid is at about 4.4. Now, Stubhub, I would say this EV 2019 sales price is probably a bit under what it should be, because of how the market has done since then. Obviously, in 2019, 2020, and 2021, they wouldn't have done well, but there's a recovery play in place right now that's pricing some of these guys up a bit, and Vivid is certainly getting a valuation based on that. So let's say if it's sold today, it'd be about 20% higher. You're kind of in line. You're at 4.3, they're at 4.4. Net income wise, free cash flow wise, I don't have those comparisons, but I would say Stubhub probably has similar DNA that you can kind of get a net income to. Did they have a net income to adjusted EBITDA calculation anywhere over here? I don't think so. Free cash flow wise, if you're looking at EV over free cash flow, these guys are pretty good at flat cash flow conversions when it comes to some of these other guys, especially Live Nation. I mean, Live Nation has a lot of physical areas that they own, so free cash flow isn't really the best comparison there, but this is a pretty decent EV over free cash flow when compared to some of these other guys. EV over revenue is in line with Stubhub, so valuation seems fair at $10. I don't think this is an unfair valuation in relation to some of these other guys that are in the space. Again, Live Nation, different, comparable. You can't just break out the Ticketmaster business, which probably drives a lot of their profitability, honestly. But it's still somewhat comparable. Stubhub's in there, Vivid's in there. They're in line with Stubhub, which makes me feel okay about this valuation. Transaction overview. Let's see what they're actually doing. So they still have debt. So it's actually 2059. All right, so that brings it very close to Stubhub there. What's happening? They're using $677 million to pay down debt. There's a rollover. There's some brokerage costs for a lien break, one of their loans that they had, and a transaction fee of about 3%. Public shareholders are getting 20% of the company. Pipe and sponsor investments are about 20% of the company, and then shareholders own 61%. And there's warrants, founder shares converted to warrants. 17 million are struck at $10, and 17 million are struck at $15, with an additional 6 million issued to shareholders. So you're talking about 195 million shares outstanding. I just want to see what kind of dilution to expect here. Potentially 34 million in warrants at a certain price point. Sorry about that. So excludes the includes rollover shares, the pipe shares, the sponsor shares, and 50,000 shares, and 38 million pursuant to the warrant exchange, and 9.8 million Spac shares, excluding 15.6 held by sponsor. Includes and 50. So 3 is where the hell is 3? 1, 2. Am I not seeing 3 anywhere? 4. Oh, why am I so blind? Oh, okay. Sponsor investment includes held by sponsor, and then all founder shares, ensure tax-free exchange, and then existing shareholders will be issued 6 million warrants in Hoya Intermediate, which will be struck ratably at 6 million at the same ratio. And then, do they have warrants? How many warrants do we have outstanding? Seems no redemptions. All redemptions backstop via an affiliate. Excludes impact of 13 million warrants. So it's got 13 million additional warrants, 7.7 held by sponsors. Struck at 11.50. Also excludes 2 tranches. Yep. And so you're talking about something like this, where your potential dilution once warrants are exercised is 25%. So that's a lot of dilution here also that you're looking at. So the good thing is that they are targeted at a certain price. So, the stock market goes to 11.50, some get diluted. So you'll probably kind of go back down to a certain valuation. And then you've got a $10. So immediately you're 17 million diluted at $10, right? So your valuation, to me, the valuation is closer to this is clearly your EV right away based on the dilution, right? So at that point, you're kind of overpriced. You're potentially diluting by about 8%. And this is the problem with SPACs. This is why sometimes you'll see SPACs drop after merger, because this dilution does happen. People, if it hits 11.50, there's going to be an additional, 24 million shares that are potentially issued. There's potentially already 17 million shares beyond this already issued, right? This does not exclude those tranches. If it hits 15, there's another 17 million shares issued. And this doesn't benefit the company in any way. It's not like they're getting additional money for this. It's just diluting the investor. And that's why SPACs sometimes have a tough time dealing with post-merger prices, because there's so much dilution happening. And here, this seems like quite a bit of dilution, right? With all these tranches being issued, 25% in price dilution could be bad for investors, which makes me a bit weary here, especially with the valuation kind of being where it is. So, do I like this investment? I don't know. So you've got some depreciation of about 93 million off of 400 million in revenue. Net income is actually negative. That kind of makes it hard to compare Ebitda for these companies. So these guys are rocking 24. These guys were rocking 16. 14. I mean, it's clearly an estimate in terms of, they have double the revenue. Maybe they have double the DNA, something like that. But valuation-wise, is it fair? Yeah, maybe, kind of. I wouldn't feel like I'm getting ripped off at $10. My concern here is that it's not a growth business, right? So why am I paying 4x revenue for something that's growing like the stock market, and the stock market grows at, is priced at 3x? I mean, the answer to that is this business has a lot better cash flow conversion than just the S&P 500 does on average. So you're getting a lot more cash flow generation, which could potentially mean a lot more investment in the business and potential further growth. But that hasn't really happened yet. What are they going to do with that additional money now that the debt is paid off? Is it just going to be more marketing spend? Is the marketing spend and royalty spend basically a necessity to retain the number of users they have and not keep their revenue from dropping, because everyone in the industry is spending a ton of money on marketing and driving users to switch between apps to sort of get the best deal. If there's a loyalty program here, or hey, come buy a ticket with StubHub and you get $50 off your first order, or then come buy a ticket with Vivid and you get $50 off your first order, come buy a ticket with SeatGeek and you get $50 off your first order. Is that the business model they're in? Beyond that, there's quite a bit of dilution. All of these shares that are being issued to the founders, it's quite a lot. This doesn't seem like it's structured amazingly for investors with the amount of warrants out there and the amount of warrants issued to the founders. That's a lot. You're talking about the founder shares being converted to warrants. Oh, okay. So it's founder shares being converted to warrants. So it's not as bad, right? So you're potentially saying that this company has to be at a certain price, but they're still issuing a lot more warrants than the founder shares that are being converted, even at the $10 mark. So this seems to benefit the founders in terms of the conversion. So not an amazing deal for investors, even if you take 13. Let's say we remove this to get rid of the founder shares. I'd have to go into the S1 to kind of deal with that. It's still 20% dilution at the end of the day. Again, you have to reach $15 to get all of that dilution, which is at that point good for investors and will be not as impactful to the overall price. But I don't know. This isn't the investment for me. For one, I don't know enough about the secondary ticket marketplace to say that this is going to do any better than something like StubHub. And the valuation seems fair. So maybe if the market's going to return 8%, this will follow suit. The upside to this would be, hey, can we do any of this stuff that we're laying out here? Can we gain market share? Can we get better at marketing? Can we see the industry grow beyond what we're projecting? And can we see the average order size increase due to that? And if you believe that's the case, then I think this is a good investment. I don't think this is a bad investment by any means. I do like the business model itself as an investor. I don't love it as a consumer, simply because it produces so much cash, right? And that cash is going to be good for investors, right? They can push it into further marketing spend. They can try to grow. They could try to grow market share through that. They could, potentially somehow make new products that they can make money off of, whether it's to the buyer space or the seller space. I think this is an interesting platform. This is probably the only pure play secondary marketplace investment. And if you are betting on a rebound beyond what your, kind of your return to norm, a rebound that's going to be, people are crazy thrilled to go out and they're going to spend a ton of money on these events and these guys are going to do well. If you believe that's true, then this is an investment you could probably make, right? Because you kind of need that to be true to be an investment that's beyond just a market return. And market return isn't bad, but if that's the case, why am I investing in this with all of these warrants outstanding and potential dilution when I could just invest in the market, right? I have to believe that this thing is going to benefit from an outsized recovery that is going to become the new norm. If I want to hold this for a couple of years, if I want to hold this for the short term, I kind of have to believe that the recovery is going to happen quickly and these recovery plays are going to gain heat and run up because of that. The valuation of this could easily expand, right? You've kind of seen that with Live Nation expanding a little bit in recent times. I'm sure if StubHub was selling today, it'd probably sell for a lot more than 4.05 billion. So these recovery plays certainly have some merit to them, and this is a really good one, right? If you want a recovery bet, this is a really good one. Just be aware that long term there's going to be dilution. Long term, that recovery is kind of going to normalize, and these guys haven't been growing at a rapid pace, right? They're comparing themselves to companies that are growing at 40%, and maybe that's fine, right? But they're using a really beneficial year for them to make that comparison, and then in this revenue growth, they're really using that Ebitda margin to spice up that valuation, and that's fine. And that's something you have to really appreciate about this business. This is a high EBITDA margin business compared to some of these other online plays. This is a high free cash flow conversion business compared to some of these other plays. And that's really good, right? That should drive a higher valuation than the market. And if you really believe in that, then this valuation isn't bad, right? 4x on a really good free cash flow generating business isn't terrible. But it's probably not for me. I don't think I'm going to invest in this. I just don't. I would have to dive deeper into the actual warrant dilution here. It seems quite high. I would have to actually dive into Vivid Seats as an app versus some of the other apps. Can they make this happen? If they can make this happen, right, this thing could double easily, because this is a real upside play when it comes to the market recovery, right? If the recovery is, I think this is pessimistic, right? So I think these valuations are better than what they show here, because I do think the recovery is going to be swift and heavy, right? And if it's swift and heavy, then companies like this will really benefit. And if they can use that to gain market share, if they can use some of this additional money that they're getting to gain market share in this space, then this could be a really, really good investment. But I just don't, right now at least, I'm kind of putting it in the too difficult pile for me until I do more research. And if I do more research, I'll make another video on it. But on the face of it, it looks like a fine investment. It looks like an okay investment. It's not blowing my mind, but it's a good business. Generates cash flow. That's what you want to see in a business. It's mature. The revenue's reasonable. Revenue growth is kind of dull in terms of what you would expect from a app-based online business, but maybe they can improve that with the opening. And the valuation's fair, right? The valuation's fair against some of the other comparables. I don't think it's crazy what they've paid for this. And this is an actual mature-ish business that's still growing, generating money. It's what you want to see as a SPAC investor in these more turbulent times where, we've kind of gotten past the silliness. Well, maybe we haven't gotten past it, but there's been a lot of silliness of, 2025 revenue companies being valued at $3 to $4 billion that have, no revenue and no free cash flow. Now you're getting a business valued at $2 billion that's already got revenue, that's already got cash flow, that's got upside of the opening, that's got, that could basically run with the market if there's a boost to these opening plays. And I don't see this as a bad investment. But I just feel like there's other investments in the market that I like more, some of which I did videos on. But if you're looking for an easy reopening play to put a few bucks into, this could be it. I think that's certainly a good case to make. And I think it's not a bad investment. It's just not for me. So let me know what you guys think. Let me know if you guys use the app, if you like it. Otherwise, if you don't, let me know as well. I do kind of want to do more research on these apps and see which one is actually the best, because at the end of the day, if Vivid Seats is the best app, then this will happen naturally, right? And that's making this a much more interesting investment, right? If they can gain market share in this very profitable business, then suddenly this valuation looks really good, right? And since this is already a free cash flow business, they're getting a cash infusion, they're going to have a better balance sheet, then this could really become an interesting play if they start gaining market share. If some of these growth rates become, in the 10% plus range, then I'm suddenly very interested in this business. But right now I'm kind of like, it's fine. It's fine. So I'll do more research and I'll maybe invest, but right now I don't know enough about the app itself and the underlying business model to make a call, beyond the fact that this is, a fine valuation for a reopening play that could easily run if market sentiment shifts towards these reopening plays in a big way. And it's the only pure play secondary ticketing marketplace play that you can get. Anyway, thanks for watching. Have a good day, and let me know what you guys think about this investment.